Hi, I'm Dr. John McCallig. I'm an assistant professor of accountancy at University College Dublin. I published a book on introductory financial accounting using IFRS that you can download at the link below. This playlist of videos explains all the important concepts and techniques that are in the book and that you will need to prepare basic financial statements. I've included a link to the playlist of videos below as well. Please remember to like the video and subscribe to the channel if you found this content helpful. This video is about the indirect method of preparing the cash flow statement. Profits are not equal to cash flow. Profits are measured using accrual accounting, and this is not the same as cash flow. We know that accrual accounting means that transactions are recorded when they occur, not when they're received or paid in cash. So profits are likely to be really quite different from cash flow. There's lots of reasons for this. The simplest one to look at is depreciation. When we buy an asset, then the cash flow of the full amount of the purchase of the asset goes out of our bank. However, the cost of the asset is recorded over multiple periods if it's going to provide benefits over multiple periods. So profits will not show the cash outflow from the asset at the start, but they will show the cost of the asset over a number of periods. We could also look at things like receivables and payables. We can record a sale to our customers without them actually paying us. So we would create a receivable in our balance sheet. This will mean that we will recognize the profit from the sale, but we don't actually have the cash in our bank account. That will come later. So there's lots of examples of profits being different to cash flows. Cash flows provide investors with good information though, so we do provide investors with the cash flow statement, which is prepared from the income statement and the balance sheet. This is called the indirect method, where we actually prepare firstly the balance sheets and the income statement, and then we work our way back to cash flows, essentially by reversing most of the accrual accounting that we've done already. Okay, so this video will show you a short illustration of how this works and why it works as well. So the accounting equation, as we know, the accounting equation says that assets minus liabilities are equal to equity. We can break this down. We can say other assets plus cash minus liabilities equals issued share capital plus retained income. So that's just breaking each part down here. We break assets into two bits. We're leaving liabilities alone for the moment, and we break equity into two bits. So that's just breaking it out a bit. The trick with the cash flow statement is to now look at the changes between two balance sheets. So we write this equation in terms of changes. When you've got an equation like this, you can also write it in terms of changes. In mathematics, you'd use a delta to signify that you were talking about changes. So the change in other assets plus the change in cash minus the change in liabilities is equal to the change in issued share capital plus the change in retained income. So all we've done here is write out the equation that we had up here in terms of changes. And then we just reorganize, we bring the change in cash to one side and we put everything else in the equation on the other side. Now remember, things may change sign when they move across the equal sign. So the change in retained income, that stays the same because it's on the other side already. The change in other assets, that does change signs. That becomes a minus because it's moved over. The change in liabilities, that changes sign because it's moved over. And then the change in issued share capital stays the same because it was already on the right hand side of the equation. So we can explain the change in cash with all these other things. And let's have a quick look at how this actually works in practice. So this is a balance sheet and a income statement for this company. What we're going to do now, we have no change in the non-current assets. Inventory has gone up by 10. Receivables have gone down by 5. Cash has gone from 21 to 53. So this is what we're trying to explain, this change in cash. Share capital stays the same. Retained income has gone up. Payables have gone up. And the long-term loan has gone up as well. Okay, so we're now going to try and explain how the cash changed using the equation that we had before. So the change in cash is all these other things here, and we just write it all out down here. So the change in cash, which is 32, is equal to the change in retained income, which is 22. We know, there's no dividends here, but other than dividends, the change in retained income is equal to the profit for the year, the profit for the financial year. So this is like profit. We subtract the change in other assets like receivables and inventory. And we add back the change in liabilities like payables and the long-term loan. There's no change in issued share capital, and we get back to our answer again. So this is how the cash flow statement works. This isn't a real one, but this is an illustration of how it works. And you'll see when we get on to the real ones, that they basically were using the same structure as we use here. So to summarize, profits are measured using accrual accounting, and this may be different to cash flows, but investors still need information about cash flows, so we have to provide them with the cash flow statement. We do this using the indirect method, which means that we work back from our balance sheets and our income statement to the cash flow statement. We don't reanalyze all the transactions again and classify them into were they received or paid and work it out that way, which we could, but we don't do it that way. We work back from the income statement and the balance sheets. This works by reversing all of the accrual accounting, and you'll see this more clearly when we look at more advanced examples. We do things like add back the depreciation because that is an accrual item. It is a non-cash expense. Okay, thank you very much for watching. Remember to like and subscribe if you found this content helpful. Bye.